Hello investors, welcome back to another video. The year 2020 has been a nasty year for businesses and economics worldwide as the pandemic affected the lives of everyone. The airline, energy, and service sectors were the most affected ones. There was pessimism everywhere and many experts predicted the end of the stock market. However, interestingly, the S&P 500 index generated a double-digit return of 15.7% in 2020. Despite the slowdown in economic activity due to illness-induced shutdowns. The other popular indices such as Sensex, Hang Seng, and SSE Composite also gained double-digit returns during the year 2020. The stock market seemed to be completely detached from the reality, and the markets are moving up every day. So the question arises, if the stock market is overvalued, and will it most likely crash in 2021? Well, let's find out. Before we dive into the details, smash that like button so that the videos will reach to a broader audience. And also, subscribe to our channel to get notifications while we post a new video. Let's get started. First of all, there are two things you need to understand about the stock market. Number one, the stock market is not the economy. Many investors don't understand the fact that the stock market does not mirror the economy. The stock market is always ahead of the economy, which means that it is the anticipation of investors where economy will be in the future. Number two, nobody can predict the stock market crash. Nobody, whether you are Warren Buffett or Charlie Munger, can predict if the stock is going to go up, down, or sideways in the short term, or if the stock market will crash any given year. The best thing you can do is to gather the facts, make educated guesses, and be prepared for it. So at first, you need to understand why the stock market keeps going up these days, and if it crashes this year, how can you be prepared for it? There are mainly two main reasons for that. Firstly, after the so-called illness affected our economy, the central banks all over the world drastically reduced interest rates to near zero. This made parking your money in CDs, fixed deposits, and other bank instruments worthless. Also, the lower interest rates affected the bond yield. So investors really don't have any instruments to get better returns than the stock market. This made all of them invest a lot of money in the stock market. Second factor is the introduction of vaccines. Many countries have acquired the vaccines to vaccinate their citizens, containing the further spread of the illness. While the economic activities have largely resumed, investors believe that the pandemic situation will improve further. The slowdown in the pandemic is likely to have a positive impact on the stock markets globally, as economic activities and trade resume at full scale. So those are the two main reasons the stock market keeps going up every day, because there's a lot of optimism in the market. Although countries have been working aggressively to contain the illness, there lies some potential risk as well, which can keep the stock markets under pressure. So let's discuss what are the factors that contribute towards potential market crash this year. If the vaccination programs doesn't go well, and the new strains of the illness spreads faster than expected, investors will lose confidence and sell off their investments. Also, the government cannot keep bailing out airlines, services, and energy sectors for too long. They have to get back to the business and start making money, or else there will be a series of bankruptcy filed by those companies, which will have a chain reaction and affect the stock market. The excessive stimulus packages, as well as low interest rates, can fuel inflation, resulting in high input costs for businesses. Central banks will have to adjust the interest rates, keeping in view the inflation rate of the country, so that it does not get out of control. High inflation causes high interest rates, which can shift investors from stock markets to the bond market, leaving the stock market in the doldrums. But you may be wondering, what about the valuations then? Is the stock market really overpriced? Well, one way to find out is to check their Shiller PE ratio. Shiller PE ratio is the big brother of PE ratio. It is based on average inflation-adjusted earnings from the previous 10 years, also known as cyclical adjusted PE ratio. So, where does the PE ratio of S&P 500 stand now? Well, it's at 35.11 as of making this video. The historical average is around 16.78. Yeah, as per the Shiller PE ratio, the stock market is expensive right now. But it was expensive last year and was also expensive the year before. So if you have been sitting on cash for the last few years, you would have lost a lot of the gains. Timing the market is a hard game. Nobody can do it right all the time. So even though the stock market is expensive, there is really no alternative right now for you to invest to grow your money. So the best strategy for you is to keep investing in a broad-based stock index fund every single month and hold it for the long term. You really don't have to care if the market's going up or if it's crashing, because over the long run it will always go up. But you should always have 3 to 6 months of expenses sitting in cash or in a money market account, because a market crash means that you have a higher chance of losing your job or getting a pay cut. So if you do not have an emergency fund, you would have to sell your investments during a crash, which is the worst time to sell a stock. So in conclusion, always have 3 to 6 months of emergency funds sitting on the sidelines and continue to invest in a broad-based stock index fund every month. So that's all for today, guys. Hope you have gained some meaningful knowledge from this video. Will the stock market crash this year? What do you think? Post in the comment section below. And if you like this video, give us a thumbs up, as it really motivates us to create new videos. Also, subscribe to our channel to get notifications while we post a new video.